All right, so today we're going to do a little detective work.
Oh.
Yeah. We're going to try and figure out what a learning session might be about just by looking at the sponsors.
Okay.
So think of it like this. Knowing who's backing a learning session
Yeah.
can give you some clues about the topics and perspectives that might be covered. It's like a sneak peek
Okay.
into the section's agenda before you even see it.
Interesting.
So for this particular session, we've got two sponsors.
Okay.
Paul Shaw from RDSP Investment and
Okay.
SoundyMax.com.
Oh, wow. Well, right off the bat, that's fascinating to me
Yeah.
because, you see RDSP investment there.
Yep.
That suggests to me this learning session might have a strong financial component.
Yeah, that's a good point. I mean, you don't usually think of investments in audio technology going hand in hand.
Right, exactly.
Yeah.
So, that they could be focusing on the business side of audio technology.
Yeah.
Maybe RDSP Investment is interested in things like investing in audio startups or even teaching musicians and podcasters how to manage their finances.
Well, that's a good point. Now that you mentioned podcasts,
Yeah.
that makes me think about the other sponsor, SoundyMax.com.
Right.
They're all about audio tech itself, right?
Absolutely, yeah. Having SoundyMax.com involved suggests that the session could dive into the technical side of audio production, recording, maybe even things like sound design or audio for virtual reality.
So we've got an investment firm and an audio tech company sponsoring this session.
Okay.
This unusual combination. It's really interesting.
Yeah.
Are we going to learn about using music to make money?
It's certainly possible. Or, maybe it's even broader than music.
Yeah.
Perhaps they're looking at the business of audio content creation, like how to create, market, and monetize podcasts or audiobooks or even sound effects.
That's a really great point. So to recap, we have Paul Shaw representing RDSP Investment, bringing that financial expertise. And then we've got SoundyMax.com in the audio tech corner.
Right.
Possibly covering the production and technical side.
And this raises an interesting question, I think, for everybody listening.
Okay.
Given what we know about these sponsors, what direction do you think this learning session might take?
Yeah.
Is it about the financial side of the music industry, or perhaps about using audio technology for business and communication? There's a lot of potential here.
Yeah, a lot to think about.
Definitely.
Thanks for listening, everybody.
Yeah, thanks for joining us. All right, so today we're going to take a deep dive into the QQQ,
Okay.
as always. And everybody knows it's the ETF that tracks the NASDAQ 100. So it's essentially a VIP club for all those big tech giants. But what we're really trying to figure out is how traders use it to make some serious money.
Yeah, and what's interesting is that because it's the QQQ is so tied to the tech sector, which is known for its roller coaster rides.
Yeah.
It creates a very unique landscape for trading.
Yeah.
You've got a high reward potential, but with equally high risk.
Totally. And someone put together a fantastic overview of various QQQ trading strategies.
Yeah.
And it's pretty extensive. We're talking everything from super fast intraday scalping to playing the long game with options, writing those market trends, even strategies for those who, love going against the grain.
It really highlights how even with one instrument like the QQQ, you can approach the market from so many different angles.
Yeah.
But I think a key takeaway is that, you need to find the right strategy for you. And that all comes down to what are your goals and your risk tolerance.
Exactly. So we're not all adrenaline junkies, right?
Exactly.
So today we're going to break these strategies down in a way that makes sense.
Sounds good. No matter what your level of trading experience is.
Perfect. Yeah. We'll look at the core principles.
Yeah.
The potential rewards. And, of course, the risks involved.
All right. So let's kick things off.
Okay.
With something that sounds like it's straight out of Wall Street.
Okay.
Intraday scalping.
All right.
So we're talking quick trades, sometimes happening within minutes, all based on tiny price movements.
Okay.
Imagine being glued to those 1-minute charts all day.
Oh, yeah.
Talk about a need for caffeine. Intraday scalping is definitely a high-stakes game.
Yeah.
It relies very heavily on technical indicators like moving averages and the RSI to spot those fleeting, super short-term trends.
Yeah.
Goal is to grab small profits from these quick price swings.
So it's like surfing.
Yeah.
Catch a quick wave, hop off before things get choppy.
Yeah.
But you need to be like a pro surfer to pull this off, right?
It's a great analogy. And just like surfing,
Yeah.
it takes practice and a lot of skill to ride those waves without wiping out.
Yeah.
Risk management here is absolutely essential.
Got it. So let's move on to something a little less intense.
Okay.
Swing trading.
Right.
It sounds more like riding the momentum wave for a few days or even weeks.
Exactly.
Right.
Swing trading with the QQQ involves pinpointing those peaks and valleys on the price chart, often using tools like Fibonacci retracements.
Okay, hold on. Fibonacci retracements.
Yeah.
For those of us who don't speak fluent trader, can you give us like a quick explanation of what those are?
Yeah, so think of it this way.
Yeah.
Let's say the QQQ's price is steadily climbing, then takes a little breather.
Yeah.
Fibonacci retracements act like guideposts,
Okay.
helping you identify those price levels where the breather might end and the upward climb resumes.
Oh.
It's like a more strategic way to buy the dip.
Interesting.
Yeah.
So you're taking the guesswork out of those dips and buying with a bit more strategy.
Right.
I like it.
Yeah.
But even with swing trading, which seems less risky than scalping, I'm guessing risk management is still key.
Absolutely. You never want to ride those waves without a life vest.
Right.
Things like knowing how much to invest in each trade and using stop-loss orders are crucial to protect your capital.
Duly noted. Okay, now let's venture into the world of options trading.
Okay.
Full disclosure, this is where I usually need a little extra help.
Sure.
We're talking calls, puts, spreads. Is it as complicated as it sounds?
Options can seem intimidating at first.
Yeah.
But they actually offer a lot of flexibility and control,
Okay.
both in how you leverage your money and manage risk.
Okay.
The source that you shared highlights two main approaches.
Okay.
You've got your zero DTE options.
Zero DTE.
Yeah.
That sounds a bit like jumping out of a plane without a parachute.
Well, it's definitely not for the faint of heart.
Yeah.
Zero DTE stands for 0 days to expiry, meaning these options expire on the same day you trade them.
Got it.
It's extremely high risk, high reward,
Yeah.
and mainly used for speculation on those quick intraday price movements.
So you're basically betting on whether the price will go up or down.
Exactly.
Within a few hours.
And because they expire so quickly,
Yeah.
that time decay or how quickly they lose value is a huge factor.
Right.
So even if you guess the direction of the price right,
Yeah.
you could still lose if it doesn't move enough.
I'm starting to see why that's high risk.
Yeah. What about the longer dated options?
So those are typically a bit more grounded.
Okay.
The source mentions LEAP APS, which stands for Long-Term Equity Anticipation Securities.
Okay.
These have expiration dates that can be years away.
Wow.
Which lets you take a bullish or bearish stance on the QQQ over a longer period.
So if you're feeling optimistic about tech's future over the next few years,
Right.
Lead PS might be a way to get in on that action.
Precisely, but it's important to remember that risk management is still essential, even with more time on your side.
Right.
The source also talks about vertical spreads, which involve buying and selling options at different price points. This can actually help limit your potential losses while still giving you the chance to profit.
Okay, so it's like creating a buffer zone to protect yourself if things go south.
Right.
Options are definitely something I need to explore further, maybe with a cup of chamomile tea to keep things calm. It's all about using the right tools for your individual goals and risk tolerance.
For sure. Moving on from the options roller coaster, we've got seasonal and trend-based strategies.
Right.
This one piques my curiosity.
Sure.
Because it's all about patterns, which I find fascinating.
It's all about using historical data and market trends to make smarter trading decisions.
Okay.
For instance, the QQQ often sees a boost in performance during earnings seasons.
Okay.
And those end-of-year rallies.
Right.
That's when those big tech companies are reporting their financial results.
Right. Everybody's hoping for a good report card.
Exactly.
So if you're playing the seasonal game, you might want to be more bullish on the QQQ
You might.
during those periods.
Right.
But what about the trend following part?
Yeah, so trend following is like riding the wave of market sentiment.
Okay.
Traders use tools like moving averages, think of them as trend lines on a chart, to figure out if the overall market is moving up or down. If the QQQ is trading above those lines, it's generally considered to be in an uptrend, and vice versa.
So it's like catching a wave and riding it for as long as it lasts.
Yeah.
But knowing when to jump off before it crashes.
Exactly.
Yeah.
But just like any good surfer,
Yeah.
a trend-following trader needs to be ready to react
Yeah.
to those unexpected changes in the tide.
Speaking of going against the tide, the next strategy is for those who like to zig when everyone else zags, mean reversion.
All right.
What's the thinking behind this one?
This is where we get a little contrarian.
Okay.
Mean reversion is based on the idea that prices tend to gravitate towards their average over time.
Okay.
So if the QQQ swings too far in one direction, up or down, traders using this strategy bet that it'll eventually come back to its average price.
So if a hot new gadget sends the QQQ skyrocketing, a mean reversion trader might be thinking, okay, this is getting a bit overheated. Time to cool down.
Exactly.
Right.
They'll use tools like Bollinger Bands.
Yeah. And the RSI. To spot those extreme price movements, think of Bollinger Bands as guardrails on a highway.
Yeah.
If the price veers too far outside those guardrails, it might be a sign that it's time for a correction.
So it's like the classic buy low, sell high strategy, but with a more technical approach.
Right.
Makes sense. Okay, we've covered a lot.
We have.
But there's one more strategy that's especially important.
Okay.
For those of us who might already have a good chunk of our savings in tech.
Right.
Hedging.
All right, so hedging is all about managing risk.
Okay.
Especially if your portfolio is heavily exposed to one sector, like technology.
Yeah.
The source suggests using tools like QQQ puts or inverse ETFs like QQQ to protect yourself from potential losses if the market takes a nosedive.
Okay, walk us through that. What are puts and inverse ETFs, and how do they act like a safety net?
So imagine a put option as an insurance policy for your tech investments.
It gives you the right, but not the obligation to sell the QQQ at a certain price before a specific date. So if the market goes down, the value of your put option goes up, offsetting some of those losses in your portfolio.
So it's like buying insurance for your tech stocks.
Yeah.
Gives you peace of mind if things go south.
Exactly.
What about those inverse ETFs?
An inverse ETF like QQQ is basically designed to be the QQQ's mirror image.
Okay.
If the QQQ drops 1%, the CQQQ goes up 1%. Yeah.
So by owning some shares of QQQ, you're creating a counterbalance to your tech holdings.
Exactly.
If the market takes a dip, your QQQ gains can cushion the blow.
Precisely. But remember, hedging isn't a free lunch.
Right.
You're making a bet that the market will go down, and if it goes up instead, you could lose money on your hedge.
It sounds like hedging is a strategy that needs careful consideration, weighing the potential risks and rewards.
Absolutely. It's a tool to be used strategically, not something you do on autopilot.
This has been an incredible overview of some seriously powerful QQQ trading strategies.
It is a lot,
But before we get into the nitty-gritty of each one, I think it's crucial to talk about risk management.
Absolutely.
You've sprinkled it throughout our discussion.
Right.
And the source definitely highlights its importance.
You're absolutely right. You could have the most brilliant trading strategy in the world.
Yeah.
But if you don't manage your risk, it's like building a house on sand. It's all going to come crumbling down.
Yeah.
Risk management is arguably even more important than the strategy itself.
Okay, I'm all ears.
All right.
What are the key things we need to remember?
Yeah.
To avoid blowing up our accounts and ending up back on our parents' couches?
So the source points out several essential risk management techniques.
Okay.
So let's break them down.
Yeah.
Let's start with position sizing.
Okay, position sizing 101. Tell me everything.
Which is all about deciding how much of your money you're putting into each trade.
Right.
Golden rule is never risk more than 1 to 2% of your total trading capital on any single trade.
So if I have $10,000 to play with, I shouldn't bet more than $100 to $200 on a single trade?
Correct.
That sounds pretty conservative.
It is.
But I'm guessing it's all about protecting yourself from those big losses?
Exactly. You don't want one wrong move to wipe out your entire account.
Right.
It's about staying in the game, even if you experience some losses.
Right.
Which are inevitable.
Makes sense. What's next on the risk management checklist?
So stop loss orders.
Okay.
These are your best friend in the trading world.
Okay.
They instruct your broker to automatically sell your position if the price drops to a certain level.
Ah, so it's like an emergency brake. You're saying if this trade goes south, get me out before I lose my shirt.
Precisely. Stop loss orders are your safeguard. against those big unexpected losses. They help you stay disciplined and prevent emotions from taking over,
Right.
which is especially important when the market gets crazy.
So position sizing and stop-loss orders, two key tools
Right.
for keeping our cool and our capital intact.
Absolutely.
What else should we be mindful of?
Staying informed is crucial.
Okay.
The source specifically mentions keeping a close eye on tech earnings reports,
Okay.
what the Federal Reserve is doing, and any major global news that could shake things up.
Right. Those are the big headlines that can make or break the QQQ.
Right.
So we need to be news junkies to trade this ETF effectively.
Well, you don't need to live in a 247 news cycle,
Oh,
but staying aware of those major events is key.
yeah.
For example, a tech giant missing its earnings expectations
Mm-hmm.
could send the QQQ tumbling.
Okay. I'll make sure to have my news alerts set up.
Good idea.
Any other risk management tips to add to our arsenal?
Don't put all your eggs in one basket.
Okay.
Diversify your investment across different types of assets, sectors, and even geographic regions.
Right.
This way, if one area of the market underperforms,
Yeah.
you're not putting all your hopes on a single horse.
That's smart, even if I'm super bullish on tech.
Right.
I shouldn't go all in on the QQQ.
Exactly. Spreading your risk is like having a backup plan. It helps you weather those market storms.
Okay. To recap our risk management toolkit,
All right.
we've got position sizing, stop-loss orders, staying informed, and diversification. Anything else?
I think you nailed it. And remember, these principles aren't just for the QQQ.
Right.
They apply to any type of trading you do.
This has been a fantastic overview of QQQ trading strategies and the importance of risk management.
It has been.
But we've just scratched the surface.
We have?
Stay tuned for part 2, where we'll go deeper into each of these strategies
Sounds good.
and explore the tools and techniques that can help you make smarter trading decisions.
It can be fascinating to unpack the nuances of each approach and see how you can tailor them to your individual trading style and risk tolerance.
We'll be right back.
All right.
Welcome back to our deep dive into QQQ trading strategies. Last time we gave you like a panoramic view of the trading landscape, from the fast-paced world of scalping to those more strategic approaches like swing trading and options. And of course, we hammered home the importance of risk management. No matter what strategy you choose, you gotta protect your capital.
Today, we're putting on our explorer hats and going deeper into each of those strategies. We'll unpack the tools, the techniques, the potential pitfalls, and of course, those exciting profit possibilities.
We're going to be using that awesome source you shared, which does a great job of breaking down these strategies in a way that's comprehensive, but still easy to understand.
It's a great resource whether you're a seasoned trader or just starting out.
Okay, let's jump back in where we left off. We talked about intraday scalping, which is all about making those lightning-fast trades. Based on those tiny price fluctuations, I have to admit, it still makes me a bit nervous just thinking about it.
It's definitely not for everyone. It requires a certain personality type, someone who thrives under pressure, can think on their feet and make quick decisions in a constantly changing environment.
So not for the easily flustered, but for those who are drawn to that kind of intensity. What are the key things they need to know to make scalping work?
Well, the source emphasizes the importance of using technical indicators to spot those short-term trends, moving averages, for example, help you visualize the overall direction of the price, while the RSI can indicate if the QQQ is overbought or oversold.
I'm vaguely familiar with those terms, but for those who are newer to the world of technical analysis, can you break them down a bit further?
Sure, think of a moving average, like a trend line that smooths out the jagged ups and downs of the price chart, making it easier to see the bigger picture. Traders use different time frames for their moving averages, like a 9-day or a 21-day average, to get a sense of both short-term and long-term trends.
So if the QQQ's price crosses above its 9-day moving average, that might be a signal to buy, because it suggests the short-term trend is turning positive.
Exactly. It's like a little green light saying, hey, things might be picking up here. Now, the RSI is like a speedometer. The QQQ's price. It tells you how strong the recent price moves have been. A reading above 70 typically suggests it's overbought and might be due for a pullback. Conversely, a reading below 30 suggests it's oversold and could be poised for a bounce.
So scalpers use these indicators along with things like candlestick patterns to identify those tiny windows of opportunity, those quick waves to ride, as we talked about earlier.
Exactly. They need to spot subtle shifts in momentum and react fast to grab a small profit before the opportunity disappears.
It sounds like timing is everything with scalping. How do scalpers know when to jump in? And maybe more importantly, when to jump out?
Entry points are often based on the price bouncing off a support level or breaking above a resistance level. Support is basically a price floor, where buying pressure is strong enough to prevent the price from falling further, while resistance is like a ceiling.
So if the QQQ is bouncing off a support level, that might be a good time for a scalper to buy, because it suggests the buyers are stepping in and pushing the price back up.
Precisely. And when it comes to exits, scalpers use those same technical indicators as well as candlestick patterns to spot early warning signs of a reversal. They might exit a trade if the RSI starts to drop, or they see a candlestick pattern suggesting a potential change in direction.
It's a constant game of reading those signals, reacting quickly, and managing your risk. Speaking of risk management, what are the essential things scalpers need to do to protect themselves in this high-speed environment?
It all comes back to those core principles we discussed earlier. Position sizing is crucial. Never risk more than a tiny percentage of your capital on any single scalp trade. Even the best scalpers have losing trades. And if your positions are too big, those losses can add up quickly.
Right. It's all about controlling those losses and staying in the game for the long haul.
Exactly. And stop-loss orders are non-negotiable for scalpers. These orders automatically sell your position if the price drops to a certain level, preventing small losses from turning into big ones.
Okay, so scalping is a high-speed game of precision, timing, and risk management. It's definitely not for everyone, but for those with the right skills and mindset, it can be profitable. Now, let's switch gears to something a little more relaxed. Swing trading. Remember, swing trading is about capturing those swings in the market, those price movements that happen over days or even weeks.
It sounds like a more laid-back approach, at least compared to scalping. No need to be glued to the one-minute charts all day, right?
Yeah.
Swing traders typically use daily or 4-hour charts to find potential trading opportunities. They're looking for those moments when the QQQ pulls back within an overall upward trend or bounces within a downward trend.
So it's like identifying those mini trends within the bigger market picture.
That's a great way to put it. And the source points to Fibonacci retracements as a key tool for swing traders.
We touched on Fibonacci retracements earlier, but can you remind us what they are and why they're so useful for swing trading?
Sure, Fibonacci retracements are based on a sequence of numbers, where each number is the sum of the two before it. It starts with 0 and 1, then continues 0, 1, 1, 2, 3, 5, 8, 13, and so on. What's fascinating is that these numbers, when expressed as ratios, show up everywhere in nature, from the spiral patterns of seashells to the way branches grow on a tree.
That's pretty cool. But I'm still not seeing the connection to the stock market.
Well, traders have observed that these same Fibonacci ratios often pop up in price charts, particularly during those pullbacks or retracements.
Yeah.
The key levels to watch are 23.6%, 38.2%, 50%, 61.8%, and 100%.
So let's say the QQQ is in an uptrend, then pulls back a bit. A swing trader would look for the price to bounce off one of those Fibonacci levels, like 38.2% or 50%.
Exactly. Those levels often act like support, and a bounce from one of them could be a signal to enter a swing trade.
Okay, that makes sense. So a swing trader uses Fibonacci retracements along with other technical indicators to find potential entry points. But how do they know when it's time to exit a trade?
Exit points are typically based on previous highs or lows, those support and resistance levels we talked about, or even projected price targets based on the size of the swing. For example, if a swing trader bought the QQQ during a pullback and the price hits the previous high, they might consider selling, as that previous high could now act as resistance.
It's a bit like connecting the dots on a chart, looking for those key levels where the price might reverse course.
That's a great way to visualize it. And just like with scalping, risk management is crucial for swing trading. Position sizing and stop-loss orders are still your best friends. You don't want to overextend yourself on any single trade. And you need a plan for getting out if things go south.
Swing trading seems like a nice balance between patience and strategy. You're not jumping in and out of trades every few minutes, but you're still actively analyzing the market and managing your risk.
It's a popular approach for a reason. It can be a bit more forgiving than scalping, but it still requires discipline and a solid understanding of technical analysis.
Okay, let's move on to options trading, which, as we mentioned, can be a bit more complex, but it also offers a lot of flexibility and potential for profit. You mentioned earlier that I seem a little intimidated by options. I think it's all the jargon calls, put spreads, premiums. It's like learning a whole new language.
You're right. Options do have their own vocabulary. But once you get the hang of the basics, it's not as daunting as it seems. Remember, an option is essentially a contract that gives you the right but not the obligation to buy or sell an asset. In this case, the QQQ, at a specific price called the strike price, before a certain date, which is the expiration date.
Right. And we talked about those two main types of options, 0 DTE, which expire at the end of the trading day, and longer dated options, which can last for months or even years.
It's exactly. 0 DTE options are like the Formula One race cars of the options world. Super fast, super risky, and only for the most experienced traders. They're mainly used to speculate on intraday price movements. And traders often rely on tools like the volume-weighted average price, or VWAP, to help them make decisions.
Can you refresh our memory on what the VWAP is and why it matters for 0 DTE options traders?
The VWAP is basically an indicator that shows the average price that QQQ is traded at throughout the day, weighted by volume. It's like a pulse check on the market's overall direction. For 0 DTE options traders, it's helpful for gauging whether the price is likely to stay above or below a certain level in those remaining trading hours.
So if the QQQ is cruising above the VWAP and showing signs of strength, a 0 DTE options trader might buy call options, betting the price will keep rising before the day is done.
Exactly. But remember, those 0 DTE options are like ticking time bombs. They lose value rapidly as they get closer to expiry. So even if you're right about the direction of the price, you could still lose money if it doesn't move far enough fast enough.
It's like a high-stakes game of chicken with the clock. Now, what about those longer-dated options? Those seem a bit more my speed, a little less heart-pounding.
They generally are. With longer dated options, you have more time for your trade to play out, and that time decay is less of a factor. The source mentions LEAP, which, as we discussed, have expiration dates that can be years away, letting you play a longer-term game with the QQQ.
So if you think the tech sector is going to keep innovating and growing over the next few years, leaps could be a way to ride that wave.
Exactly. But remember, risk management is still key, even with a longer time frame. The source also talks about vertical spreads, which involve buying and selling options at different strike prices. It's a bit more advanced, but it can help you limit your potential losses while still allowing for potential profits.
Can you give us an example of how a vertical spread might work with the QQQ? Pretend I'm a visual learner.
Of course. Let's say you're bullish on the QQQ, meaning you think it's going to go up and you think it's going to break through its current resistance level, which we'll say is $400. You could buy a call option with a strike price of $400 and at the same time sell a call option with a higher strike price, maybe $410. This is called a bull call spread.
Okay, so you're buying one call option and selling another. How does that help manage risk?
The money you get from selling that higher strike call option helps to offset the cost of buying the lower strike one. This reduces your overall cost and limits your maximum potential loss to the difference between the two strike prices minus the net premium you received.
So in this example, your maximum loss would be $10 per share. The difference between $400 and $410 minus the premium you got for selling that higher strike call.
Exactly. And if the QQQ breaks above $400 as you predicted, both of your call options will gain value, and you'll profit from the difference.
Okay, I'm starting to see how options can be used strategically, not just as a gamble, but I definitely need to do a bit more homework before I jump into this pool.
I agree. Options can be powerful tools. But it's important to understand how they work and the risks involved before you start trading them.
We've covered a lot of ground with scalping, swing trading, and options. Let's move on to some of those other strategies mentioned in the source, starting with the seasonal and trend-based approaches.
Seasonal trading is all about identifying patterns that tend to repeat at certain times of the year. Remember we talked about how the QQQ often performs well during earnings seasons and those end-of-year rallies?
Right, like clockwork. Everyone's looking for those year-end bonuses.
Exactly. So a seasonal trader might buy the QQQ before those periods, anticipating a potential price bump.
But wouldn't everyone be doing that? Driving the price up and making it harder to profit?
That's a good point. It's important to remember that seasonal patterns aren't foolproof. Markets can be unpredictable, and what worked in the past might not work in the future. Successful seasonal trading requires careful analysis, risk management, and being adaptable to those ever-changing market conditions.
It's like you can't just set your watch to the market's calendar and expect to make money every time.
Precisely. You always need to be thinking critically and adapting to the current market environment.
Okay, so seasonal trading is a bit like surfing. You're looking for those waves that tend to show up at certain times of the year, but you also need to be a skilled surfer to ride those waves successfully. Now, how about we move on to trend following? This one's all about identifying the direction of the prevailing trend, and you guessed it, trading in that direction.
The trend is your friend, right?
Exactly.
Traders often use those moving averages we talked about to figure out the trend. If the QQQ is trading above its 50-day and 200-day moving averages, it's generally considered to be in an uptrend. If it's trading below those averages, It's in a downtrend.
So a trend-following trader would buy the QQQ when it's on the upswing and sell when it's heading down.
That's the basic idea. They're essentially riding the wave of market sentiment. But just like with any other strategy, trend following has its risks. Markets don't move in straight lines, and even the strongest trends can reverse unexpectedly. That's why trend-following traders also use those stop-loss orders to protect themselves from sudden reversals.
It's like you're riding a roller coaster. You enjoy the thrills of the climb, but you also want to make sure you have a safety harness in case things get too wild.
Exactly. It's all about enjoying the ride while managing the risks.
Trend following seems like a strategy that requires a good understanding of technical analysis and the ability to stay calm when the market gets bumpy.
Absolutely. You need to be able to read those charts, identify those trends,
Mm.
and most importantly, know when to get off the ride. Okay, now let's talk about mean reversion. This is the one for the contrarians, right? The folks who like to go against the crowd. Can you walk us through how that works with the QQQ?
Mean reversion is based on the idea that prices tend to revert to their average over time. So if the QQQ has swung too far in one direction, up or down traders using the strategy believe it will eventually return to its average price. So if everyone's getting super excited about a hot new gadget and the QQQ is going through the roof, a mean reversion trader might be thinking, hold on, this can't last forever. What goes up must come down.
Precisely. And they'll use tools like Bollinger Bands and the RSI to identify those extreme price movements. Remember those Bollinger Bands we talked about earlier? Think of them like bumpers on a bowling lane. If the price goes outside those bumpers, it might be a sign that it's time for a correction.
So mean reversion is kind of like betting on the rubber band snapping back after it's been stretched too far.
That's a great way to think about it.
But isn't mean reversion risky with the QQQ? We're talking about tech stocks here. Sometimes they defy gravity for extended periods, making it tough to predict when that correction will happen.
You're right. Mean reversion can be tricky, especially in a market driven by innovation and fast-paced growth, like the tech sector. It requires a lot of patience, discipline, and the willingness to go against the prevailing sentiment. You need to be comfortable being the lone wolf, the one betting against the crowd.
It sounds like you need nerves of steel to be a mean reversion trader, especially with the QQQ. Okay, we've covered a lot of ground with these different QQQ trading strategies, but we have one more to discuss: hedging. You mentioned it's particularly relevant for those of us who already have a significant chunk of our portfolio invested in tech.
Hedging is all about managing risk. It's like buying insurance for your portfolio, especially if you're concerned about a potential downturn, particularly in the tech sector. The source suggests using tools like QQQ puts or inverse ETFs like SIP-QQQ to protect yourself from potential losses.
Right. We touched on puts and inverse ETFs earlier, but can you remind us how they work and why they're so important for hedging?
A put option is like buying a safety net for your tech holdings. It gives you the right, but not the obligation to sell the QQQ at a specific price before a certain date. So if the market takes a tumble, your put option increases in value, offsetting some of those losses in your stock portfolio.
It's like buying insurance for your tech stocks. It gives you peace of mind knowing that if things go south, you have some protection.
Exactly. Now, an inverse ETF like QQQ is designed to move in the opposite direction of the QQQ. If the QQQ goes down, QQQ goes up.
So by owning some shares of StanQQ, you're creating a counterbalance to those tech holdings. If the market drops, your QQQ gains can help cushion the blow.
That's the idea. But it's important to remember that hedging isn't free. You're making a bet that the market will go down, and if it goes up instead, you could lose money on your hedge.
Got it. Hedging is like buying insurance. It can protect you from losses, but it also comes with a cost.
Exactly. And like any insurance policy, you need to decide if the cost of protection is worth the peace of mind it provides.
Okay, this has been an amazing journey through the world of QQQ trading strategies. We've covered scalping swing trading options, seasonal and trend-following approaches, mean reversion, and hedging. It's a lot to take in, but I'm starting to get a better sense of how these strategies work and which ones might be right for different types of traders.
It's been a pleasure diving into these strategies with you. Remember, there's no one-size-fits-all approach to trading. The key is to find what works best for your individual goals, risk tolerance, and trading style. Well said. We've laid the groundwork and explored the strategies. But there's one more piece of the puzzle we need to talk about: the tools and resources that can help you put these strategies into action.
Stay tuned for part 3, where we'll dive into those essential tools and resources that can take your QQQ trading to the next level. We're back and ready for the final part of our deep dive into QQQ trading strategies. We've explored the landscape from that adrenaline rush of scalping to the more patient approach of swing trading, and even ventured into the world of options.
And throughout this journey, we've emphasized that no matter how brilliant your strategy, it's all for nothing if you don't have a solid grasp of risk management, position sizing, stop-loss orders, staying informed, and diversification. Those are the cornerstones of protecting your capital and weathering those inevitable market storms.
Right. It's like building a house. You need that strong foundation before you can even think about adding all the fancy features. But now that we've laid the groundwork, let's talk about the tools and resources that can help you actually implement these strategies and bring your QQQ trading to life.
Absolutely. Having the right tools can make all the difference, not just in executing your trades, but in analyzing the market, backtesting your strategies, and staying ahead of the curve.
Okay, let's start with the basics. We've talked a lot about charts, indicators, support, and resistance levels. Where do people actually find all this information? I'm picturing those classic trading floors with screens flashing numbers, but I'm guessing things are a bit more digital these days.
You're right, those Hollywood-style trading floors are mostly a relic of the past. These days, anyone with a computer or even a smartphone can access incredibly powerful charting platforms and market data. The source you shared mentions a few popular options like TradingView Thinkorswim and eTrade.
So those are the go-to platforms for charting and analysis. What makes them so special?
These platforms offer a wide array of features, everything from real-time price quotes and interactive charts to a huge library of technical indicators and drawing tools. You can customize your charts, set up alerts, and even backtest your trading strategies to see how they would performed in the past.
Backtesting. That sounds like a total game changer. So you can basically simulate your trades using historical data and see if your strategy would actually work.
Exactly. Backtesting is a crucial step in developing and refining any trading strategy. It helps you identify any potential weaknesses, fine-tune your entry and exit points, and ultimately gain more confidence in your approach.
Wow, that takes a lot of the guesswork out of it. Okay, so we've got our charting platforms figured out. What about staying up to date on all those market-moving events we talked about? Any recommendations for news sources that are particularly relevant for QQQ traders?
The source mentions some solid options like CNBC, Bloomberg, and Yahoo Finance. They provide comprehensive coverage of financial news, including tech earnings, Federal Reserve announcements, geopolitical developments, basically anything that could impact the markets.
So it's a mix of traditional financial news and tech-specific updates.
Precisely. Remember, the QQQ is heavily weighted towards the tech sector, so keeping an eye on both the broader economic landscape and those developments in the tech world is essential.
Makes perfect sense. Okay, we've got our charts, our indicators, our news sources. Anything else that can help us level up our QQQ trading game?
The source also mentions backtesting software, which we touched on earlier. Tools like NinjaTrader and TradeStation offer even more advanced backtesting capabilities, allowing you to simulate your trades with incredible precision and test different scenarios.
So if I want to get really serious about backtesting and fine-tune my strategies, those are the platforms to explore.
Absolutely. They provide a level of depth and customization that's incredibly valuable for serious traders.
This has been an incredible journey exploring QQQ trading strategies and the tools that can help you put those strategies into action. I feel like we've been given a backstage pass to the world of professional trading.
It's been a pleasure sharing this deep dive with you. Remember, knowledge is power, and the more you understand about the QQQ, the markets, and the tools at your disposal, the better equipped you'll be to navigate this world.
So true. But before we wrap up, I want to circle back to something you mentioned earlier, the human element of trading. We've talked about all these strategies, indicators, platforms, but at the end of the day, isn't trading also about psychology, discipline, and managing our own emotions?
Absolutely. I'd argue that the mental game of trading is just as important, if not more so than the technical side. We can have the most sophisticated strategies and cutting-edge tools, but if fear, greed, or impatience get the better of us, it can lead to costly mistakes.
So how do we master that mental game of trading? Any tips for staying calm, focused, and disciplined, especially when the market is throwing those curveballs?
It's a journey, not a destination. But here are a few things that have helped me over the years. First, have a clear trading plan. Know your entry and exit points, your risk tolerance, and your overall goals. Don't just jump into trades randomly.
It's like having a roadmap before you set out on a journey.
Exactly. Second, once you have that plan, stick to it. Don't let emotions cloud your judgment. If a trade hits your stop loss, get out. Don't try to chase losses or make it all back on a single trade.
Discipline over emotion.
Got it.
What else?
Third, take breaks. Trading can be mentally exhausting, So step away from the screen, clear your head, and come back refreshed.
It's like any other demanding activity. You need to recharge your batteries to perform at your best.
Precisely. Fourth, learn from your mistakes. Every trader, no matter how experienced, makes them. The key is to analyze those mistakes, understand why they happened, and adjust your approach accordingly.
So it's not about being perfect. It's about learning and growing from those inevitable missteps.
Exactly. And finally, remember why you're trading in the first place. Is it to grow your wealth, achieve financial freedom, or maybe just challenge yourself intellectually? Keeping your why in mind can help you stay focused and motivated, even when things get tough.
Those are some incredibly valuable insights. I think we could all benefit from taking a deep breath, remembering our why, and approaching trading with a more mindful and balanced perspective.
Couldn't agree more. Trading is a fascinating and potentially rewarding endeavor, but it's important to approach it with a healthy dose of respect, discipline, and self-awareness.
Well said. This has been an incredible deep dive, and I want to thank you for sharing your expertise and insights with us.
The pleasure has been all mine. I always enjoy these conversations.
And to our listeners, we hope you found this exploration of QQQ trading strategies informative and inspiring. Remember, knowledge is power, and the journey of learning and growth in the world of trading never really ends.
So keep exploring, keep learning, and as always, trade wisely.
Until next time, happy trading, everyone.